I guess what we have seen during the last year will continue for some time. And at some time, I would think will be determined by how long do the events in Europe last, because that is having an unsettling impact all over the globe. Yes, we can talk about our getting inflated a little later, but what we have seen in the West, the inflationary impact and then its impact on the economy per se, I think will continue till that overhang of the global geopolitical events in Europe are settled. And you will see this disconnect between interest rates and inflation, for example, which Europe is still not, in a sense, making the right moves to get inflation under control through interest rate exercises, because they have other probably concerns, whereas the US has gone to some extent. And all this creates an even greater flux. So that's why I say till the geopolitical equation settles, we will see these economies continue to have inflationary pressure, continue to have a growth pressure. At the time, you may say they're going to recession, they say they may not be going into inflation, but it's a state of flux.
When do you think the state of flux will move from state of flux to state of clarity?
I would think that the first signs of the European conflict situation getting resolved, I think very quickly these will settle. And I think people can then take what I would call economic decisions in a true economic context. Now they have to take economic decisions, keeping in mind what is happening there in right center, as it were. And then you have got other challenges which will have to play out. For example, the whole challenge with settlement currencies and the noise that you hear about it, around it now. We have to separate fact from what is probably thought, but that also will you will get clarity. Is there going to be a relook at fiat currency? That is going to be probably something that will play out again in the next 6 months or so. And that also, I think, was a result of certain actions where very many countries thought that they should not necessarily rely on a single currency to settle, but can you do bipartite, can you do a club, and so on and so forth. So there are a lot of wheels spinning as I see, the conflict, the inflation, the interest rate impact on that, settlement currencies, payments. So all these, I think, are in a way very exciting times for in an economic context for countries around the world to go through.
Mr. Kamath, the current interest rates, do you think these are just normal interest rates, or central bankers, in their quest to control inflation, they have stomped growth, and which will cost us dearly?
If you take Europe, for example, it's a situation where inflation is still very high and interest rates are still very low. So there is a lot that central banks could do. Clearly, they have not increased interest rates, as I could see, to make it not too difficult for its constituents, the people, in terms of their daily. But that is not helping inflation. So I think the bet there is that this conflict will moderate or come to an end, and you will have the two, the interest rate and the inflation rate, come nearby. So that's one assumption. Whereas in the US, the assumption is entirely different. The assumption is that we will increase interest rates, and indeed that has had a salutary impact on inflation. And I think that policy seems to be working. But Europe is what is bothered. Then other countries have played it in their own way. For example, if I look at India, I think India has done a great job. Our policymakers have done a great job, whether it is at the Ministry of Finance level or whether it is at the Reserve Bank level. I would think that this was nicely calibrated in terms of keeping rates at a level which was comfortable and trying to bring down inflation simultaneously and keeping liquidity flush so that your growth momentum did not suffer. And I think hindsight proves that it was the right prescription that was adopted. I would think that there are several ways in which different central bankers have addressed this. I would think that the way our central bank and our finance ministers address this, to me, appears to be the most fit for purpose.
Mr. Kamath, I specifically remember we had in our previous interview, you alluded to the fact that the kind of disruption what fintechs and startups are bringing out, that is something which is real and that is something which would be changing the entire banking landscape. However, you did raise concerns about the underlying valuations at which some of the consumer tech and fintech stocks were trading. So do you think, sir, that Humpty Dumpty has had a great fall and fintech valuations are now looking reasonable?
Let me give a slightly long answer to this. There are two parts here. There are the incumbent banks and then there are the fintechs. Let me just address the incumbent banks since we last talked based on maybe 2 quarters numbers and particularly the numbers of this quarter which have just come out. I think those are exceptional numbers. Exceptional numbers, typically people say exceptional when you look at profit. But I say exceptional when you look at the health of the balance sheet. You have the leading banks all with certainly net NPA less than 1% and more like 0.5%. I would think that this is something that at least I have not seen ever in my career 50 years back, stretching 50 years. I've said it earlier in a different context. But that was capital. But now I'm saying it in terms of quality, asset quality. It's never been better that to my knowledge over the past years. One. Second, of course, getting to the balance sheet. You have again capital adequacy at very healthy levels. And I think you have also provisioning coming down on the P&L front, the provisioning coming down dramatically. So I would think that there is a perfect situation for incumbent banks to, in a way, blossom and grow as the economy grows at the projected 8-9% is my assessment that we ought to grow, and it probably will grow. So if we're growing at that rate, you need strong banks, and that will happen. So that's the banking sector, strong, healthy, and doing what it should do. Now come the digitex, the fintechs. The fintechs, yes, last time I did mention about the challenge that they have, which is they have created enormous value in the platforms, but the valuation is out of sync. Now, I have had an occasion to look at these fintechs a little closer over the last, say, 2 quarters or 3 quarters. And I stand by what I say, that they have created enormous value. In fact, they have created more value than I thought at that point in time was going to be there in their platforms. But the problem is, I think they still are not clear about their cash flow prospects. Their cash flow prospects, I think, need to be worked on, which will get the valuation right. And then you will have what I would call a good cycle for them to grow. Now, in the interim, what is happening? In the interim, they are actually in a way collaborating with the incumbent banks and partnering with them and providing products. And I would think this will be something new that will happen because as they find that they have a challenge in generating a positive cash flow, they and their funding partners will look at other opportunities to break even and make a healthy cash flow. And what are these? And these are readily available. You could put in a plug, an API plug, and be the front end or the front face for a bank. And that is happening with what we call the newer banks. And then you got also, I would say, credit card providers who are doing the same thing, who have a plug into an older bank which doesn't have the skill sets or the people or the technology to do what is required. And this interface provides that technology and gets them to market. And so on. When you dig deep, you have got so many nuances that have played out. Again, in terms of scoring a customer, not just a CIBIL score, but an overall score based on multiple feeds and multiple data, which is available in the public domain, and then getting that customer set ready. And most importantly, in my interactions, I find that the newer fintech players, they are getting the customer basically as what I would call not a walk-in, but a drop-in online through the internet connection, as it were. So it drops in. Whereas if you remember in our days, we had to appoint DSAs and we had to go out and have a physical touch with the customer, and then the customer came to us. And all credit appraisal, scoring, and so on was physical. Here now it has moved to entirely online, real time, and virtual in terms of, I would say, almost as the customer is having a buying decision, credit a credit could be made available to this customer, small or large. And this interface, as of now, I would think the fintechs have really mastered. I'm sure some big banks will master this as we go along. But for those who have not been able to master, I think the fintechs become the continuum to do this.
So, Mr. Kamath, I'd like to draw your attention to the incumbents, which you just mentioned. Banks across the board, they've reported profits like never before. Credit growth is absolutely stunning. Do you think that the credit cycle, which has started, let's say, 2 quarters ago, has a long way to go? And for next 2 or 3 years, barring 1 or 2% here or there, the uptrend in the credit cycle is real and it is here to stay?
Yeah, Nikunj, I would entirely agree with the proposition that you have made, and I'll spell out the reasons. Typically, the credit cycle will be 1.5 to a little more than 1.5 times the GDP. So if our GDP is around 8%, then we should have 12%. If you are seeing 15%, that means there was pent-up investment that not done, and you are pushing that. If it was higher than that, probably the base number is probably not fully correct. Either way, I think we are looking at a good time and good things in terms of the credit cycle. Now, credit cycles do not fizzle out very quickly. Once momentum starts happening, then it catches that momentum and growth. Why? Because what you see, the improvement in profitability, let's say, of the banks is not a one-quarter phenomenon. We have now been seeing it for about 2-3 quarters happening, and it seems growing. It seems to be getting better and better. And likewise, the corporate profitability. A few weeks back, there was some worry whether rural India was doing as well as urban India. But that again, there is commentary to say that rural India is also now ticking. So given this, I would think that we are looking at a long horizon of growth. And that long horizon of growth would mean bank credit has demand. And now, we can break bank credit into 3 parts. One is the retail part, which indeed is growing strongly and it will grow with probably in a linear correlation to GDP with a multiplier, 1.5 or 1.75 times GDP growth. Then comes manufacturing. And I include MSME and all these, the entire range of manufacturing enterprises in this. Those enterprises, I would think, have gone through a phase of resetting their balance sheet. That also is largely over. By resetting, I mean reduce debt and increase its equity, as it were. So initially, we are in a mode to pay back debt. Now they are probably using that debt to grow. Will they leverage? They will leverage as necessary. But as the cash flow is so strong, I think borrowing from this sector is going to be slow. It's not going to be as robust as in the retail sector. Agriculture sector will continue to borrow, and there is a set pattern to that borrowing, and I think that would continue. I'm sure newer credit tools will come in to facilitate the agriculture sector, and with better reach and better way of delivery of credit to this sector. Lastly, and I should have placed it up front is the infrastructure sector, which is could be a great guzzler of credit. Now here, it has to go through a disintermediation stage. Credit has to go through a disintermediation stage, because with the lessons of the last 10 years or so, I would think that both the borrower and the lender are going to be cautious that you match the right tenor, you match the right repricing formula, and so on. Given that banks typically have 1-year money, and these projects could be requiring 10-year money, so the term transformation is to be very carefully handled. I think that this will sustain. To answer your question in simple language, this will sustain. That is, the demand for credit will sustain. It will sustain from all the areas that I mentioned: retail, corporate, agriculture, and infrastructure. And it is long run.
Right, okay, and quite a bit of crack actually in the market. Just when you thought that we're going to make it back to that 17,800 mark, we've now even plunged below 17,700. So it's really getting quite vicious out there. It's another 200-point fall that you're seeing, in addition to that 1% fall that we had on Wednesday's trading session. It's really banks, telecom, cap goods, cement all the way, which are weighing heavy on the indexes. ICICI Bank is now down 3%. HDFC is down 3%. Adani Ports, Adani Enterprises down nearly about 4.5% to 4% apiece. ONGC is down 2.5%. Coal India is down quite considerably. SBI is down 2.5%. Reliance is now headed into a 2% crash, and Axis is well lower by about 2% as we speak.